Seeing what's happened with the destruction of the markets to this point, where we've come down, how we continue to face these lows and testing the lows again yesterday, what do you do at this point? Is this a situation where you jump in and buy, or do you wait and see?
Well, we sold into the rally we had back last Monday, a week ago Monday. And I think we're trying to...
Remind me of that rally. Where were we at that point?
Right after the tariff truce.
Yeah,
okay.
So that
okay.
the
one-day rally.
The one-day rally. So
call it the head fake, yeah.
I think that we're trying to think about what's next year going to bring. And I think the highest conviction I have is that earnings growth is going to be very poor next year and might even be zero. So I think
zero earnings growth, you said?
Potentially, yes.
For the S&P rate?
Yeah, so what normally happens is estimates start high, 80% of the time they come down. If you look at the average drop, you take it 8%, the consensus now, that gets you around zero for the year. So, it might be slightly positive or slightly negative, but I think right around zero. So, you probably will get a positive return next year, but it's not going to be all that great. And I think since you now can get 2.5% without any risk, if you're going to get 5% of the stock market, that's not a really compelling risk-reward proposition. So for the first time in a long time, we're actually have become to an underweight position in our multi-asset portfolios for stocks globally.
What are we trading? If you're looking at 0% growth, what are we trading times forward earnings right now?
About 15 times or so.
That's if the consensus is met.
That's correct.
So that's if the consensus is met.
So that's not expensive.
No, it's not.
But it's not screamingly cheap either. I mean, the average on a forward earnings basis is more like 12, 13. So again, not terribly expensive, not enough to worry about per se, but not so cheap that you just say, okay, I just got to buy stocks here. They're just on big sale like they were, let's say, in 2009.
Simeon, what do you do?
I think I'd be a little more constructive because when you look at those forward earnings multiples, given where we are on interest rates, I think they are a little bit cheap. And certainly we're going to have a lot less earnings growth last year. I mean, forget the 25, 26% earnings growth, focus on top line. We've had 8 or 9% top line. Let's say that gets cut in half. 4 or 5% earnings growth driven by that much top line, even with no margin expansion, is probably enough. Now, I'm not so sure we're going to get a Santa Claus rally because those are usually driven by window dressing when markets are up and PMs and folks want to get some winners just on their closing tally sheets. But
yeah, not too many winners to close out.
Exactly. But January comes around, rebalance, add back to equities. I think it's a good idea.
In the meantime, what do you do with the money of all the stocks you just sold? Where are you putting it?
I bought some bonds. So we bought some Treasury bonds.
Treasuries?
Yeah. So I'm not saying the Treasury bonds represent a tremendous value.
Would you buy the 2-year since the yield's better?
Actually, what we usually do is duration match to the Barclays aggregate. So we're not necessarily making an active bet on duration. But we're basically across the various maturities.
It's probably like a 7. What's the average maturity?
It's more like 6 and change.
Okay. One thing I've been thinking about is in terms of the composition of earnings next year, right? Because if you get down toward low single digits or whatever it comes out, 5%, it's not going to be the median earnings growth is going to be 5%. What sectors are going to look okay? I mean, obviously energies,
well, energy's at 25%. The consensus now is 25%. But if oil prices stay just more or less where they are, it's going to be hard to see you're going to get 25% growth in it. So I think you look across the market. I do think we will probably get some positive sales growth, but margins are at an all-time high. We know that wages are starting to rise more rapidly. We know that economic growth is slowing a little bit around the world. So I'm not predicting a disaster. I just think you're not going to get a lot of earnings growth next year, and therefore you're unlikely to get a lot of return.
Andrew had Paul Tudor Jones on yesterday. He said he's looking for continued volatility. You could see it up 10%, down 10%, even 15% on either side. But he also said if stocks went down another 10% from here, it would basically be a screaming buy. Would you agree with that? I think
down another 10%, we'd be more likely to get back up to a neutral and overweight position. So, and one way to think about it is, let's say the expected return for stocks is 5%. In other words, just 2.5% over the risk-free rate. Is that high enough to bear the risk of the stock market? So how do you get the expected return up? Well, either prices go down a bit so that the expected return in the future goes higher, or time goes by and earnings catch up. But I don't think we're quite there yet. I suspect that we'll have a little bit more of a rougher patch before we get to a more normal market.
The other call I thought, which was so interesting, was basically the Fed's not going to touch the lever at all next year. Do you think that's
zero rate?
Well, the neutral rate for Fed funds, most people now think is only 1% above inflation. So that's 3%, not 4%, which is what we might have thought 25 years ago. So Big deal. So they stopped slightly short of that. I do think that has implications, though. And there are folks calling for emerging markets, which is very sensitive to tightening, to have a little bit of resurgence if the Fed's backing off. The caveat to that, though, is remember, we're not the only central bank in the world. This month, the ECB will cap those purchases at about 2.5 trillion euros. So it's not so clear that there's going to be a backing off of tightening from other central banks, but still, emerging markets an opportunity, and maybe even small caps in the U.S.
What does that mean for the dollar?
I think the
With
dollar
with what our central bank versus everybody else.
Yeah, I think if we are ahead of the curve in a sense, then the dollar's run of strength may be waning, and we've seen that in the last couple of weeks.
Which would mean what in terms of your investments?
Well, it does mean that there perhaps these more opportunities internationally than there were in the past. We know the valuation is incredibly compelling, both in developed and emerging markets. The geopolitical headwinds have been there, but if there's any sort of truce on trade wars and any reasonable outcome of Brexit, there ought to be a little bit of a rally there.
We did rotate some money into emerging market equities. And I think part of the idea is that if the Fed stops sooner rather than later, maybe another 1 or 2 hikes, the biggest beneficiary might be emerging markets more than U.S. stocks. So I think that there's better value there. You know, there you really are looking at levels that look very cheap by historical standards. So I think you get a bit more bang for your buck now in emerging markets than you do in U.S. equities.